You want to invest in a stock, but have no idea whether or not now the price is cheap or expensive. When people are saying, buy low and sell high, what does that really mean? When does the stock's price is considered low, at $5 a share, $10 a share, or at $50 a share? There's no easy and simple answer to these questions. But there are some metrics to at least gauge how expensive the stock is, compared to the underlying business. These metrics are used for valuing companies and to find out whether they are overvalued or undervalued. Today we will explore something called the P/E ratio, or price-to-earnings ratio. The price-to-earnings ratio, P/E ratio, is the ratio of a company's stock price to the company's earnings per share. If share A is trading at $24 and the earnings per share are $3, then share A has a P/E ratio of 24/3 equals 8. Generally speaking, the higher the multiple, the more expensive a stock is considered. Some investors may say that a P/E of 20 or higher indicates a relatively high valuation, and a P/E of 15 or less indicates a relatively low or more conservative one. But there is no set formula for applying P/E. If it's 15 you buy, and if it's 25 you sell doesn't work. You can think of that as like a price per pound at supermarket when shopping for pork beef. It's difficult to compare the total prices since the quantity you get is different for each cut of meat. But if you look at the price per pound, then you can easily figure out if the price you are paying is low or high. There are multiple versions of the P/E ratio, depending on the type of earnings used, forward and trailing P/E. The trailing P/E relies on past performance by dividing the current share price by the total earnings per share over the past 12 months. It's the most popular P/E metric and the common meaning of P/E if no other qualifier is specified. The forward P/E uses future expected earnings. Estimates are typically derived as the mean of those published by a select group of analysts. Of course, you must decide whether you agree with the projections of the analysts, or whether the business has changed to such a degree that these projections no longer make sense. The median P/E is the median statistical P/E over the past 10 years. A current P/E below the median shows possible underpricing or changes in business fundamentals. If the current P/E is higher than median, the stock may be overvalued. Not forget to check the interest rates. If interest rates are decreasing, then probably P/S will tend to increase. In addition to showing whether a company's stock price is overvalued or undervalued, the P/E can reveal how a stock's valuation compares to its industry group or a benchmark like the S&P 500 index. The all-time highest S&P 500 was 123.73, measured in May 2009 after the market crash, and the lowest was 5.31 found in December 1917. However, except for some brief periods, the average P/E ratio was mostly between 10 and 20. In 2020, following the 2020 coronavirus crash, the trailing P/E ratio reached 38.3. This elevated level was only attained twice in history, 2001 to 2002 and 2008 to 2009. When a company has no earnings or is posting losses, in both cases, the P/E will be expressed as N/A, so you will have to find some other metric to value your company. In general, a high P/E suggests that investors are expecting higher earnings growth in the future and expect the business to perform well. For example, Tesla had a P/E of over 1,300 in year 2021. Now in 2022 P/E is around 90, what is still very high compared to 10 of Toyota and 6 of General Motors. Shares of Enron stock reached their highest price in year 2000 when shares reached a price of $90.75. The high share price gave Enron a market cap of about $70 billion, enough to make it the 7th largest publicly traded company. At the time, the company was trading at a price-to-earnings multiple of over 70. However, beginning in September 2000, the company's stock began declining, analysts and investors began to scrutinize Enron's financial statements. Less than 2 years later, Enron's stock price would be 12 cents. A low PE can indicate that investors are expecting lower earnings and the deterioration of the underlying business. For example, investors are expecting multiple problems and growing competition with Meta, Facebook. This is reflected in a low PE of 10 in 2022. Just 2 years before, in 2020, PE of Meta was over 30. Google's PE ratio now is where it was during the pandemic crash. It hasn't been that low since the 2009 crisis. To many super investors, Google looks relatively cheap for such a great business. In fact, in 2022 more than 20 super investors bought Google stock, including LiLu, who increased Google shares by 77%. Investors sometimes look for extreme variations of PE from the mean, believing that these variations are temporary and could be caused by a bad press release or negative short-term headwind. If this short-term headwind will eventually disappear, the multiple may return to its previous level. Of course, assuming a company's core business remains unchanged. Banks, food producers, and steel companies mostly have had low PE ratios. But does that mean they are a good investment? Sometimes, maybe. Ben Graham recommended looking for stocks with a low PE relative to the market. He also suggested that different stocks should have different PS. Growth stocks could have a PE in the 20s, while others should be lower. Graham recognized that good bargains have current PS lower than historic PS. Graham's advice to investors generally was to avoid stocks with a PE higher than 20. Always be wary of cyclical stocks. The value may just be apparent. Basic industries, such as natural resources, paper, farm machinery, automobiles, may look tempting with low price-to-earnings ratios and high earnings growth rates. But a closer look at the long-term may show years of low earnings or even losses. Look back at the long term and be conscious of business cycle dips. But in the PE ratio there's more information than meets the eye. The intrinsic meaning of the PE ratio tells us how many years it would take to regain an investment if earnings stayed the same. A PE of 10 means that with flat earnings, it would take 10 years just to recover your investment. A PE of 70 means 70 years. That's a very long time. You won't wait 70 years just to get your money back. Maybe something else is at work to support a high PE, or is just market excitement. That something can be growth potential or understated current earnings. You can look at PE as a metric for the return on invested capital. A PE ratio of 50 implies a 2% return on invested capital. This is $1 return per $50 invested. If you turn PE ratio upside down, a greater revelation occurs. The inverse PE ratio, known as earnings yield, tells the annual percentage rate of return on invested capital. The formula is 1 divided by PE. If PE is 10, then 1 divided by PE is 0.1, or 10%. This is $5 returned per $50 invested. This way of looking at PE is the equivalent of a yield the investor would use to compare to another investment, a bond, for example. As I'm recording this, the 1-year Treasury bond yields almost 3.5%, the highest it's been since the early 2000s. A bond returning $3.50 on $100 yields 3.5%. A stock returning $3.50 in earnings on $100 invested, stock price, could also be said to yield 3.5%, and would have a PE ratio of 28, $100 divided by $3.50. Earnings yield makes the meaning of PE more clear and can be used to compare to other investments including bonds. If you buy a bond for $100, you receive $3.50 per year for 10, 20, 30 years. The yield at 3.5% still doesn't seem all that great when inflation is this high. If you buy a stock for $100, earnings per share of $3.50 in 10, 20, or 30 years will remain the same or they'll change. Of course, they'll change. If the earnings decline, you definitely should have bought the bond. But suppose the $3.50 earnings grows at 10% per year. What happens at the end of year 10? This is the compounding formula. 3.5 times 1 plus 10% to the 10th power is $9.08. If the price were to stay the same, your $100 investment would be returning $9.08 in year 10, which is almost 10% earnings yield, or a virtual PE of 11 at today's price. That is an attractive, nice yield. In this case, the price of your investment should go up, because thanks to the increased earnings it's worth more. When interest rates are low, PS tend to be higher. 10-year treasuries are the best example for a risk-free rate of return. When the 10-year treasuries are under 5%, the equivalent earnings yield converted to PE exceeds 20. That's also why many investors now think many stocks are undervalued. A market PE of 20 is attractive when interest rates suggest a PE exceeding 28. Unless higher interest rates are coming. When looking at PE, you may check also consistency and trend. Consistency. Inconsistent PE ratio may refer to cyclical industries but can reflect also problems in management or competitive struggles. Trend. Growing profits and financial strength are very desirable and may reflect in the PE trend. Multiples like PE ratio can certainly help you make investment decisions. You need to ensure that your decision is based on a thorough understanding of the business, not just the stock's multiple. Like when you see a steak selling at $2 a pound, make sure to check the quality and if that the steak is actually a steak. When you come home, you may find that the steak you bought it's a lower quality or is expired and it smells bad. Just because something is cheap doesn't mean you should buy it. As Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Relying on valuation measures alone can give you a superficial view of company performance, especially with unusual items like one-time write-offs. One-time items can skew a company's earnings and revenue positively or negatively. For example, companies in the oil and gas industry frequently sell assets to generate cash when oil prices are low. These one-time gains would increase earnings. You should draw your own conclusion as to whether a company that has frequent one-time items, such as gains from the sale of assets, is in financial trouble. A better approach to find companies you like is to look on their fundamentals and only after that find some appropriate metric to understand the business valuation. However, no single ratio can tell you all you need to know about a stock. Before investing, it is wise to use a variety of financial ratios that we will explore in the next videos.